Welcome back as we move on to study credit risk premium. We'll learn the relationship between the business cycle and the credit premium and briefly discuss on credit risk in sovereign bonds. Let's get started. Thus far, we've focused our discussion on sovereign bonds where we've made the assumption that they are default-free, so they do not carry any credit risk. However, we cannot make the same assumption for sovereign bonds issued by developing countries, nor bonds issued by corporations. The discount rate for bonds with credit risk should include an additional risk premium known as the credit risk premium to compensate investors for the risk of a default. We denote this credit premium as gamma. You would have learned a lot about credit spread under the fixed income course, so we'll not go into much detail. The business cycle does not only affect the real risk-free rate, but also the credit spread. Research has shown that defaults increase and recovery rates decrease during periods of economic weakness. Both effects result in greater credit losses during economic downturns. As such, credit spreads tend to widen during times of economic downturns and narrow during expansions. We can say that there is an inverse relationship between the business cycle and credit risk premium. Since the real rate is positively related to economic growth expectations, the real risk-free rate should increase when the economy is expanding, while the credit premium should decrease. Since price and yield have an inverse relationship, we should expect credit-risky bonds to outperform default-free bonds when an economic growth improves. Reverse the arguments, and we have a case of credit-risky bonds underperforming default-free bonds in a recession. We can take this further by distinguishing between higher-rated risky bonds and lower-rated risky bonds, which have larger credit spreads that are more sensitive to the business cycle. Overall, lower-rated bonds tend to benefit more than higher-rated bonds from a narrowing of credit spreads because their yields fall by a greater magnitude. Conversely, when credit spreads widen, higher-rated bonds will outperform lower-rated bonds on a relative basis as the yields increase by greater magnitude. Credit spreads can also have different sensitivity to the business cycle based on industry or sector. This sensitivity can be related to the types of goods and services that they sell or to the indebtedness of the companies in the sector. Companies in cyclical industries like durable goods manufacturers and consumer discretionary tend to be relatively more sensitive to the phase of the business cycle as their revenues and earnings rise and fall with the rate of economic growth. In contrast, companies in defensive or non-cyclical industries like manufacturers of consumer non-discretionary goods tend to be relatively immune to fluctuations in economic activity. That is, their earnings tend to be relatively stable throughout the business cycle. As such, spreads for issuers in the consumer cyclical sector increase significantly during economic downturns compared to spreads for issuers in the consumer non-cyclical sector. Let's look at an example. The real risk-free rate for the US market is estimated at 1.5%, and expected average inflation over the next year will be 4%, and the premium required by investors for inflation uncertainty is 0.5%. A $100 par 3.5% annual coupon corporate bond with 1 full year to maturity is currently trading at $94.70. What is the implied credit spread embedded in the bond's price? Pause the video now and work out your answer. And we're back. Let's first calculate the yield the corporate bond is trading at. This is a 3.5% annual coupon bond, so the value is expected to be 103.5 at maturity. This works out to a yield of 9.3%. Given the nominal risk-free rate, the credit spread works out to 3.3%. Next, an unexpected global health scare is expected to quickly lower the real risk-free rate by 0.3% and increase the credit spread to the corporate bond by 0.9%. Assuming all other expectations remain the same, what price should the bond be trading at? Pause the video now and work out your answer. And we're back. Based on the adjustment estimates, the new yield of the bond should increase by 0.6%, which works out to 9.9%. Discount the final cash flow by 9.9%, we get a current value of $94.18. And lastly, let's briefly discuss sovereign credit risk. This usually applies to sovereign bonds issued by the governments of developing or emerging economies. Even though many of such countries can technically print money to pay off debts, many countries like Russia, Argentina, and Mexico have defaulted on their debts in the past, as printing money is never a sustainable solution to repay debt. Collectively, sovereign credit spread for emerging markets increases during notable periods, like in the case of a global recession. Developed market sovereign bonds were often thought to have little or no credit risk. However, in the aftermath of the 2008 global financial crisis, investors have come to realize that the bonds issued by developed countries also run the risk of default. Such possibilities can be observed from the CDS premium that investors pay to insure against a sovereign debt default by a named developed country. For example, the CDS premium that insures against default on Italian government bonds rose from close to zero before the crisis to a high of 400 basis points in 2012. And that's all you need to know for credit risk premium. Next, we'll learn the equity risk premium and liquidity premium. See you again.